Imagine transforming a modest rupees 10,000 monthly investment into a steady 1 lakh monthly income in your retirement years. This is the power of compounding, a strategy that rewards you for starting early and staying consistent with your investment. By leveraging the growth potential of systematic investment plan SIP and later transitioning to a systematic withdrawal plan SWP, you can accumulate a substantial corpus and enjoy financial security. In this video, let us understand how this approach allows you not only to build wealth during your working years but also to ensure comfortable retirement income for decades. Welcome to holisticinvestment.in. To explain the combination of systematic investment plan during accumulation phase and systematic withdrawal plan for retirement, consider the following scenario. This will help you understand how to accumulate wealth and then transition to a reliable retirement income plan. Starting at the age of 25, imagine setting aside just rupees 10,000 every month into a systematic investment plan. With consistent contribution for 30 years and assuming an annual return of 12% per annum, this disciplined approach would allow you to accumulate a significant corpus by the time you retire at the age 55. However, there are certain assumptions built into this calculation. First, consistency. It assumes that SIP is continued without any interruption for 30 years. The key to wealth accumulation is staying invested throughout the term despite market ups and downs. Regular disciplined contributions are essential for leveraging the power of compounding. The second assumption is that the investment yields an average return of 12% per annum. While this may seem optimistic, it is based on historical data. Many equity mutual funds, for example, have delivered robust returns over long periods. As shown in the table here, several funds have been in the market for nearly 30 years and have achieved returns exceeding 12%. These funds demonstrate that long-term investment in equity funds can generate substantial returns. While equity investments generally tend to perform better over the long term, they do come with inherent risk due to market volatility. This is why we have assumed a 12% per annum return as a conservative estimate. By investing consistently in a well-performing mutual fund, the assumption of 12% returns becomes realistic, highlighting the potential for accumulating a substantial corpus after 30 years of disciplined SIP investment. Let's dive into calculation now. Monthly SIP contribution 10,000, investment period 30 years, annual investment rupees 1,20,000, total investment 36 lakhs, expected returns 12% per annum, final corpus at age 55 is 3.08 crores. This growth occurs due to the power of compounding. The longer you stay invested, the more your money multiplies over time. The idea is to take advantage of market growth while you are still earning an active income, allowing you to build a sizable retirement fund. Next, transition to retirement with SWP. Once you reach the age of 55 and retire, you can switch your accumulated corpus to a systematic withdrawal plan, which will provide you with a steady monthly income during your retirement years. Here how it works. First, scenario 1, monthly income rupees 1 lakh. You take the rupees 3 crore corpus and invest it in a diversified portfolio with 40% in equity and 60% in debt. The equity returns are assumed to be 12% per annum while debt returns are 6% per annum, resulting in a weighted average return of 8.4% per annum. You then start withdrawing rupees 1 lakh per month as retirement income. This allows you to maintain a comfortable lifestyle without depleting your retirement fund too quickly. With the SWP, lump sum investment at age 60 is rupees 3 crores, monthly withdrawal rupees 1 lakh, returns during SWP period is 8.4% annually, withdrawal period 35 years, that is life expectancy of 90 years. Final corpus at the age of 90 is 26.85 crores. This plan ensures that even after 30 years of withdrawing rupees 1 lakh every month, you will still have a healthy sum of money left, which can serve as a financial cushion or inheritance for your loved ones. Scenario 2, inflation adjusted monthly income of rupees 1 lakh. In retirement, it is essential to account for inflation when planning your withdrawal strategy. The cost of living naturally increases over time, and without considering inflation, your fixed withdrawals may lose purchasing power, impacting your lifestyle in later years of retirement. Let's explore how you can adjust your withdrawal plan to maintain the same standard of living throughout the retirement period. In the previous example, we assumed you could withdraw rupees 12 lakh annually during your retirement without adjusting for inflation. However, with an average inflation rate of 6% per annum, your purchasing power could diminish significantly over time. To safeguard against this, you need to gradually increase your withdrawals to keep pace with rising prices. By adjusting the withdrawal amount each year to match inflation, you ensure ensure that your 1 lakh withdrawal today will have the same purchasing power 10, 20 or even 30 years from now. Although withdrawal amount increases, the returns on your remaining corpus should ideally outpace inflation, preserving your wealth over the long term. Calculation for inflation adjusted withdrawal. Year 1 withdrawal rupees 12 lakhs, year 2 withdrawal rupees 12.72 lakhs, year 3 withdrawal rupees 13.48 lakhs and so on. Year 35 withdrawal rupees 92.23 lakhs. By the time you reach your later years, you may be withdrawing significantly more, but your lifestyle and purchasing power will remain steady, unaffected by inflation. This inflation adjusted withdrawal approach ensures that your retirement income keeps pace with the rising cost of living. Even after adjusting for inflation over a 35-year retirement period, the combination of careful planning and 8.4% return on investment and disciplined withdrawals would still leave you with a substantial corpus of rupees 12.17 lakh by age 90. Here is the conclusion part. There are two important phases in financial planning: the accumulation phase and the distribution phase. The SIP and SWP can serve as effective tools during these phases respectively. By starting early with an SIP and transitioning to an SWP upon retirement, you ensure a smooth and systematic approach to financial independence. With just rupees 10,000 per month during your working years, you can build a corpus of rupees 3 crores by retirement. This sum, when invested wisely, can provide you with a monthly income of rupees 1 lakh for 30 years, ensuring a worry-free retirement. However, scenario 2 emphasizes how inflation can impact long-term financial planning and why it is essential to account for inflation during retirement. The key takeaway is to start early, stay consistent, and allow your investment to grow over time, ensuring a financially secure future. A detailed blog post on this topic is available on our website and the link is given in the description.
And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.